Hi, I'm Al from money.co.uk, and today we're talking about buying shares. The idea behind share trading is simple. Sell for more than you buy and pick up a cut of any profits the company makes along the way if possible. The problem is, if it was that simple to pick the winners, everyone would be doing it and no one would ever lose money. Clearly, that's not the case. So while no one can tell you which stock will be worth 10 times its current value next year, what we absolutely can give you is some ways to tell you if you're about to make a terrible mistake. The first thing to look out for is a rocketing share price. When a rocket shoots upwards, there will be a few people that get incredibly rich. But rockets fall back to earth and things do not end well for people left on board when they crash land. So if a share has been soaring, dig into why. Are the company's revenues rising? Is that growth sustainable? Where will the future profits come from and how realistic is that? Unless you find good answers to those questions, it's safer to step away. Similarly, if the company is too cheap, you need to ask why. A quick measure of whether a firm is over or undervalued is its total value versus its earnings, or the P/E ratio. Generally, a P/E ratio of between 10 and 30 is normal, with the overall P/E of the FTSE 100 ranging between about 10 and 35 over the past decade, spending much of that at about 15. So if you see a company that's seemingly worth less than 5 times its earnings, ask yourself, why isn't everyone else buying it too? Dividend cuts are a red flag too. Are there plans to delay paying a dividend if there isn't one in place? Companies are very careful about setting their dividends at a level they can afford, so if they're cutting them or delaying them, something has gone very wrong with their plans. Asset write-downs are another warning sign. When companies buy or own something, they set the value of them and add it to their balance sheets. Cutting this value down is effectively saying the company is now worth less than it thought it was and can see the stock price tumble as a result. Worse, this can go on for months and even years as they reassess the worth of their assets. If debt is rising faster than a company's assets or equity, that's a problem. If a firm is spending money it doesn't currently have, it should be on something valuable, and that should be reflected in the balance sheet. If debt is rising faster than that, it could be a sign that borrowed money is being used to pay for everyday operations, and that's simply unsustainable. A quick look at the debt to equity ratios of similar firms can let you see if the debt level is out of whack versus competitors, and potentially unsustainably high. That's a quick, if far from exhaustive, list of things to tread carefully around when buying shares. Of course, every company is different and no one has all the answers. But if something fails any of these tests, make sure there's enough elsewhere to make up for it before parting with your hard-earned cash to invest in them. That's all from me today. For more information, head to money.co.uk.